Hey folks, welcome back to Wash Capital, and to this week's Market Analysis Explainer. This detail covers the week of June 22nd to June 28th, 2026. If you've been looking at the headlines, you'd probably assume this was a bad week for markets. The NASDAQ fell 4.24%, its sharpest weekly decline in several months. And if that's the only number you tracked, you'd have walked away from the week thinking markets were under meaningful stress. They weren't. And understanding why is what this explainer's for. We'll cover the week's dominant framing first, rotation versus breakdown, then the full market update, the oil and commodities picture, a deeper look at how to read a sector rotation, the Valkyrie model portfolio, and finally, the distribution outlook and risk barometer. Let's get into it. The first thing to address is the most obvious one. The NASDAQ fell 4.24%. Mega-cap technology names sold off on mounting concern that the extraordinary level of AI capital expenditure being committed by the hyperscalers is compressing near-term profitability before it delivers proportionate returns. If you only track cap-weighted indices, that reading felt alarming. But the Dow Jones Industrial Average rose 0.6%. The Russell 2000 gained 1.22%. The FTSE 100 rose 1.18%. That's a nearly 5-point spread between the NASDAQ and the Dow in a single week. That's not a market in distress. That's a market in rotation. And in distributional analysis, the distinction is everything. The cap-weighted structure of the NASDAQ and the S&P 500 is why this misread happens so consistently. The largest names, like the Magnificent Seven, carry disproportionate index weight. When they sell off, the index falls, regardless of what the other 490-odd constituents are doing. The index measures the giants, not the average company. The most important data point of the week, by some distance, is this. By midweek, 63% of S&P 500 stocks were trading above their 50-day moving average. That's up from 50% at the start of June. Advancing stocks outnumbered declining ones, even on days when the index itself was negative. That's improving breadth in a falling index. That's the distribution signal. The NASDAQ number isn't. Globally, the equity tape was defined more by what each index is exposed to than by any single directional force. The FTSE 100 rose 1.18% to 10,475, supported by its composition toward financials, energy defensives, and consumer staples. Natural insulation against a tech-driven narrative. Emerging markets fell 3.75%, pressured by dollar strength at multi-year highs, and the risk-off sentiment that NASDAQ weakness tends to transmit through EM capital flows. Global developed equity ex-US declined a more measured 0.81%. On rates, both Treasury yields fell in the week. The 2-year moved to 4.096%, the 10-year to 4.376. That narrowed the behind-the-curve premium from approximately 43 basis points last week to approximately 35. The bond market's doing what Report 28 said it likely would if the energy disinflation thesis played out. It's compressing the rate hike tail, quietly, incrementally. The VIX rose 12.13% to 18.40. It's elevated, but it's not alarming. At 1840, it remains below the 20-year risk regime threshold that's defined the analytical boundary throughout this series. The more important signal is that the MOVE, which measures bond market volatility, barely moved, edging to 66.79. In Report 26, VIX and MOVE rose sharply together. That was the systemic configuration. Broad-based regime uncertainty spreading across both equity and fixed income simultaneously. This week, only equity volatility repriced. That's a sector story, not a regime event. Commodities, oil, and the OMOIL framework. Brent fell 8.83% to $73.04. WTI fell 8.81% to $69.67. OMOIL, the Oman physical crude benchmark we've tracked since Report 22 as a deal probability indicator, fell a more modest 2.99% to $69.99. The OMOIL to Brent spread is where the analytical signal lives. Last week, that Brent premium sat at $7.96, the most constructive reading in this framework's history, reflecting physical buyers pricing no Hormuz corridor risk at all. This week, that premium narrowed to $3.05. Brent fell nearly 3 times faster than OMOIL. The read I hold is this. Iranian crude is now reaching global markets, and it reprices the paper barrel first. Brent, as the global benchmark, absorbs new supply immediately. Oman physical barrels sold into a more regional buyer pool follow on a lag. The spread narrowing is supply normalization, not risk re-embedding. The Brent premium remains intact. Physical buyers in the Hormuz corridor aren't pricing corridor risk back into the market, even against some rising regional tension on Friday. They're adjusting to a world where Iranian crude's no longer absent from the market. The spread is doing what it should as the geopolitical premium resolves into a supply competition dynamic. Gold fell 2.18% to $4,070, continuing the structured decline from the conflict period peak. The distribution fingerprint called in early March remains on track. Each weekly decline validates the prior framework, rather than introducing a new one. When the index lies, and how to read the rotation beneath the surface. A sector rotation is capital moving in a sustained directional way from one part of the market to another. It isn't panic selling. It isn't a single event. It's the cumulative result of thousands of individual allocation decisions being quietly revised in response to changing macro conditions. The skills learning to read it within a distribution framework, rather than reacting to the index number sitting on top of it. Different sectors respond to different macro inputs. High multiple technology companies are sensitive to the discount rate applied to future earnings. Defensive sectors are less rate sensitive and more demand stable. Financials often benefit from yield curve dynamics. Small caps are sensitive to the front end of the rate curve through their floating rate borrowing costs. When yields ease and energy disinflation flows through, as both have done in recent weeks, the relative attractiveness of those sectors shifts. Rotation's the market repricing that shift, one allocation decision at a time. It's structural, not emotional. So, what moved? Industrials gained approximately 3% on the week. Healthcare gained over 2%. Financials added close to 1.7%. Small caps advanced. The Dow rose. The Russell rose. And the NASDAQ fell 4.24%. Because the AI narrative trade ran into a delivery question, the market had been willing to defer, and this week chose not to. The concern being repriced is return on AI investment. The hyperscalers, Amazon, Microsoft, Google, Meta, have committed to roughly $700 billion in annual AI capital expenditure, on the premise that AI capabilities will generate proportionate returns. That's a defensible long-run thesis, but markets are forward-looking, and often impatient. When expectations get priced in ahead of delivery, any slippage in the narrative gets punished. What repriced this week wasn't the AI thesis itself. It was the premium being paid for it, relative to what the near-term earnings evidence can currently support. A repricing of premium is a rotation event. A structural reversal is something else. On this week's evidence, it's the former. The breadth data reinforces that read. The asymmetric risk deserves an honest mention. If AI earnings guidance is revised materially downward, not just questioned but actually cut, the orderly rotation has the potential to become disorderly. Capital moving from tech to industrials is a reallocation. Capital moving from equities to cash, triggered by a large cap earnings deterioration, is a different problem. We're not there, but the distribution includes it as a tail. And tails are how portfolios get damaged when they're ignored. The Valkyrie portfolio. No changes this week. Gold has declined from the Valkyrie exit level of $4,543 in Report 25 to $4,070 this week. Bitcoin has declined from the exit zone of 73 to 74,000 to 60,281. Both zero position calls validated themselves again this week. The system identified the deteriorated risk-adjusted profile in each case. The exits were rules-based. The results have followed. This is the practical value of signal discipline over conviction. Avoiding drawdown in deteriorating assets and the associated volatility drag is risk management, not forecasting. The equity sleeve absorbed a mixed week across all three legs. The NASDAQ's decline was partially offset within the US allocation by the Dow and Russell's gains. The global developed sleeve benefited from the FTSE's advance. The EM allocation declined alongside the broader EM tape. No allocation approached a rebalancing threshold. The diversification did what diversification does. The 40% cash position is preserved optionality, not a bearish forecast. The distribution is improving, but it hasn't resolved. Patient capital in that environment is an active form of risk management, not a passive one. No signals are near threshold. The model leads. The distribution outlook and risk barometer. This week's data nudged the distribution further toward the base and bull scenarios. The bear case sits at 13%, down from 15% last week. The base case holds at 53%, up from 52%. The bull case sits at 34%, up from 33%. The distribution skew, alpha, sits at approximately minus 0.08, the least negative reading in this series' history. The distribution's approaching symmetry, incrementally, without drama, which is exactly how distribution should improve, in my view. The risk barometer holds at moderate risk, stabilising. A step back from last week's improving reading, as the tech rotation pushed the volatility category to a slight headwind. 4 categories remain constructive: policy, inflation, geopolitics, and growth. 2, volatility and liquidity, are neutral to slight headwind. For the barometer to move to low risk, we need VIX to demonstrate sustained sub-18 behaviour and the September FOMC data to confirm the look-through hold. Those are the confirmation events still ahead of us rather than behind us. The distribution is improving. The destination is not yet confirmed. And in a regime that rewards patience over conviction, that's precisely the appropriate posture to hold. That's the explainer for Report 29. If it added clarity to your week, sharing it is the best way to support the work. Until next week, stay safe out there.